Hi, Gary and Kevin here from Chicago, and this is the second quarter market update. You know, it was interesting this first quarter. Interesting is the right word, but kind of oil prices went down. The market kind of went with it, down 12% to February 11th, and boom, bounced all the way back up. And you wouldn't know the difference if you came back March 31st because it was basically even.
Right.
And now it's come up another couple percent. It's back to about even again. And so there's a bunch of factors going on out there in the marketplace. GDP came in at 0.5% for the first quarter. But it's come in that way for the last 2 years in January, the first quarter of those years. And it was interesting, Warren Buffett spoke on Squawk Box a few days ago and said, you know, I never pay attention to, you know, that quarterly number because if you do the math, if you're up by 0.1 or 0.2%, it throws the whole thing off. He looks at the longer term GDP, which you should make note of. But there is something in that number, and Kevin, I want to ask you about that. I mean, it's got to do with what's going on in corporate America. What is that?
Well, in terms of the GDP being, obviously you have energy affecting it, and it's still taking a while for as energy contracts because the price of oil being at the levels that it's at now, it makes a lot of the projects that have come on over the last 5 or 6 years uneconomical. Mm-hmm. So if they can't sell oil at $50 a barrel, then they're not going to try and take it out of the ground because that's how much it costs them.
Sure.
So, you know, the suppliers and that whole chain, it finds its way through the system. So they're thinking that the market profits were down, say, 9% in the first quarter. It largely might have been flat or slightly up, absent energy. Mm-hmm. A lot of that has to do with the dollar, too. When you translate a stronger dollar and you translate profits back into U.S. dollars, that's an impediment. You also have wage growth slightly being positive because unemployment's been down. You've actually been people coming back into the workforce that formerly were out. So that's maybe a source of maybe some prognosticators thinking that the profit growth will recover in the third and fourth quarter because there is better wage growth. There'll be more spending. Maybe it'll be consumer discretionary. It will be impacting things more.
Yeah, and interesting you say that because we've had great job growth, 250,000 jobs a month, and actually the unemployment rate went up because people are coming back in the workforce. So that's a real positive. The other positive, you know, it's not talked about much, is the budget deficit. You know, in 2009, coming out of the crisis, it was minus 11%. Mm-hmm. We were pulling out, over $1 trillion. It's now down to minus 2.5. Why is that important? Well, because typically the economy grows at about 3% a year long term. It's been a little less than that. So if it's at 2.5% and the economy will grow long term at 3%, then we're kind of stopping accumulating a lot more debt anyway. We still have the debt to deal with.
Not making it grossly worse, but marginally.
Right. And so we still have to grow our way out of or somehow mitigate that debt that's there to continue to be a strong nation. But you know, that problem in itself is something that has a long-term fix because there's social programs are being paid for that are expensive and other things that have to be addressed, you know, sometime in the near future.
Well, let's be honest. Profits drives the equation, and growth ultimately is what leads to profits. And so the accumulated debt is an impediment for growth coming back to be the 3 or 4% historical measure, so that you can actually begin to pay down debt and affect structural reform. So the worldwide banks are trying to inject money into the system to try and get the dollars and the currencies getting the velocity of money increasing to actually create real growth. And absent that real growth, then you have dislocations and you have higher volatility in the markets. Yeah. It's a natural result to it until you have some continuity and some true momentum, which we've been waiting for quite a while. Yeah.
So, and the other thing is, you know, the Fed, you know, at least beginning of the year, said they're going to have 5 interest rate, you know, rises this year, and instead they've now said they're going to have 2 of them increases because they're a little concerned about the growth and that kind of thing. So it seems like we're still on this very slow growth path that we've been on forever. And I know, Kevin, you and I talked about it. There's not a lot of exuberance.
No.
Which is not a bad thing.
And there's not the past excesses, which is what normally leads to recession. So a lot of the professionals out there continue to think that we're not in a recession, although that's always a fear. And if you have a recession, you have a 20% decline in profits, you'll see the market go down.
Right.
We do have profits tight this year where I want to watch this thing. You kind of want to hold it close to the vest. If it's not 5-year, 10-year allocations, you're probably erring on the side of caution here.
Yeah, you want to make sure you have money available for cash flow in case we do run into a recession, but long-term money wants to stay where it's at and be careful. Oh, like Warren Buffett would say, you know, I was born in 1930 and now he said in the same interview that it's 6 times greater than I was a kid.
Right,
He goes, what do you
right.
think it's going to be, 20 years from now? That's an important point. So I want to leave you with that, and we'll come back in the summer and see what's happening with this wonderful political race, which is fun to watch, I guess, if you want, at least for a real reality show, and see what happens with the markets and the economy and everything else. So saying so long here for another quarter.
Thank you.